Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Investor in the Family Radio, we believe that you can become a great investor. How? By building the right plan and then sticking to it. And according to Warren Buffett, that really is all that it takes to set yourself apart. And everything we do here is meant to help you get there. So thank you so much for joining us. You can always find more at investorinthefamily.com and subscribe to the podcast at iTunes, Stitcher, and the Google Play Store. And on today's show, we're going to be going through this week's Up and Down Wall Street column from Barron's magazine. And this week, Randall Forsyth is back. Was on, I guess, vacation or something for a couple weeks, but this week Randall Forsyth is back on the Up and Down Wall Street column from Barron's magazine, and this week's article is entitled "Making U.S. Stocks Great Again." So you can probably understand the play on words or parallel he is making with Donald Trump's campaign of "Make America Great Again," and a lot of this week's article is going to be on the recent rallies with the S&P 500, the Dow, really all the major indices here in the U.S., as a result of Donald Trump's election back in early November. And I will take a brief moment right now to remind you that during this holiday season, if you're doing any shopping at Amazon and you want to support this podcast, simply go to investorinthefamily.com/Amazon. That's investorinthefamily.com/Amazon. If you go there, you will automatically be redirected to Amazon.com, and it'll be the exact same website you would have gone to anyway. The only difference is, since you went there through my link, I will get a very small affiliate percentage on every purchase you make at Amazon. The cost to you will be no different than if you go there directly yourself. It's basically Amazon pays me a little extra commission for that, helps support the show, and no cost to you. So thank you so much for doing that. Investorinthefamily.com/Amazon as you're doing your Christmas shopping. So back to this week's episode, making U.S. stocks great again. Well, shareholders the Dow Jones is on the cusp of 20,000. So that's will be yet a new record, and really is actually a meaningless number, but it seems like a big deal because it's a nice round number. Just like, who cares if a running back gets 100 yards in a game or 1,000 yards in a season? Well, it doesn't really matter, but it's a nice round number, and we like to hold on to nice round numbers. And I do. I think everyone does. So for that reason, 20,000 is a big deal, and the Dow has never been there before. A lot of people expected doom and gloom and crashes and busts before this point during this bull market, but here we are on the cusp of reaching that milestone. And according to Mr. Forsyth, the shareholders owe a debt of gratitude to Donald Trump for that. So U.S. equities have grown in value by almost 7% since the election. And how much, he says, that's roughly $1.7 trillion have been added to the value of overall U.S. stock markets since the election as well. That represents that 7%. So pretty remarkable. And this all reflects mostly perceptions and expectations and not yet realities, because it's assumed most of this rally is based upon Donald Trump being elected, and that's very safe to assume that considering the timing and circumstances. But the thing is, he hasn't done anything yet. No one really knows what the impact of his decisions or policies will be, but there are a lot of perceptions and expectations on Wall Street that they will be very positive for businesses and therefore stocks. And so people are jumping on early. And I think it was last week we made the comment, or someone made the comment concerned that a lot of 2017 gains are being pulled into the present, which means we're seeing big run-ups right now, but that's just stealing future benefits in 2017. So it may end up being a wash, or not a wash, but this rally may not continue as everyone hopes it will be. So that was something that was expressed last week. So in a lot of ways, people are saying this is really a hope and faith-based rally. And really, the outlook for growth and inflation shouldn't change anytime soon, since fiscal policy won't change until after next year at the earliest, because Donald Trump, President-elect Trump, will not take office until, I believe, late January sometime. And so really nothing will change until then policy-wise. So again, this is all expectation-based. And regulatory changes that can be implemented by executive order would be most immediate and potentially the most powerful changes. It did not go into a lot of depth as to what those changes may be directly. And I know there's been lots of talk about those. And honestly, there's so much conversation out there about potential nominations by Trump and policy changes and everything else. It's honestly hard for me to keep track of what would be executive orders and what would not be and all of that. But according to Mr. Forsyth, there are some pretty significant executive orders that could be enacted by President-elect Trump immediately upon entering office that could cause some pretty immediate and significant changes economically and policy-wise and regulatory-wise. For the markets, this means, in the meantime, it means more mediocre global growth, subdued inflation, tamped down volatility, and more accommodative monetary policy from central banks because, in the meantime, nothing has changed, even though Donald Trump has been elected as president, because he's not president yet. He's president-elect. Even so, even with all of this, the fact that nothing has changed, the fact that most of the rally is expectation-based, and so on, the animal spirits of investors have indeed been aroused, and that's very clear by the rally and that has been experienced here. The boost from a Trump presidency may be a bit, and there also an argument is made that the Trump being elected may actually be a bigger boost for Main Street than Wall Street. And which I think would be a great thing. I mean, I'm fine with Wall Street benefiting, but obviously Main Street is where we, in my opinion, I want to see the biggest impact, because that has the greatest opportunity to help the most people. And Mr. Berezin, Berezin, no idea who this man is, but Mr. Forsyth quotes him. He's from BCA Research. I also do not know who that is, but since they're being quoted in Barron's magazine, I assume they are reputable. So Mr. Berezin from BCA Research thinks that rising protectionism may hurt the global economy. It's something we've heard a lot about with President-elect Trump, the idea of protectionism, looking more inward, and kind of taking care of number one here in America first, how that could hurt us and the global economy. And Berezin saying it may hurt the global economy, but the effect on the U.S. economy will likely be modest, since we're a relatively closed economy. For example, exports are only 12% of GDP. And 12% is not a meaningless number, of course, but it is still very small, considering there's 88% that is not based upon exports. So that is something to note. And he also says it doesn't make sense for China or Mexico to put up trade barriers with the U.S., like, for example, in some kind of retaliatory move, because if they do that, it's just going to hurt them and their jobs as well. So that doesn't make a lot of sense. According to Berezin, Trump's tax cuts would actually offset any new tariffs that could arise from a Trump presidency. Let's see, or new tariffs that. Okay, so Trump tax cuts would either offset new tariffs or the new tariffs would actually shift sales to domestic producers away from international producers, which would boost employment here at home. So the idea is that new tariffs actually either wouldn't hurt us or would actually help the U.S. because tax cuts would offset them, or it would bring jobs and more work back here to the U.S. So in this way, tariffs would not hurt capital investment by companies, but may actually increase capital investment by U.S. companies, because as domestic producers may have to bring jobs and production back to the U.S., this would likely boost spending or capital investment on their part, which again helps the U.S. economy. But the big capital BUT is that trade agreements are not just about economics. They're also about politics. And protectionism may benefit the U.S. economy, but it may benefit the U.S. economy at the expense of other nations' economies. And so you may think, okay, well, looking out for number one, which is the viewpoint of many, I will not get into the, I'll say, ethics of that, but that's the reality that a lot of people have. I do think I want to see things improve here at home, but, it's whatever you think is right or wrong in that regard, it is important to remember that it does have consequences overseas. Whether you care about those consequences is up to you, but it is important to acknowledge they are very real, and there are people all over the world that are impacted by these decisions. That being said, that again, trade agreements are about politics as much or more than they are about the economy, and this protectionism direction could lead to international breakdowns in lots of different ways. Of special note, it could significantly negatively impact relations with China, South Korea, and Vietnam. And so, again, made arguments for how the protectionism approach may help the U.S. economy, but it could it could increase global tensions that could lead to other international ramifications, potentially conflict, potentially combat, all that kind of stuff is out there. It's a potential reality that should be considered as well. The S&P 500 profits also may not benefit from tax cuts as much as people think, since the effective tax rate for most corporations is really around 25%, which is much lower than the statutory rate of 35%. So even if tax rates are reduced, then, it sounds like there's a really good chance they'd be reduced to levels where they're already are anyway from an effective tax rate standpoint. But that makes me wonder, well, does that mean the effective tax rate can't drop even lower? It seems like that's very logical to me. So that point being made there seems like an odd one, and I would love to inquire more deeply upon that one. But because it does seem that if the stated rate of 35% decreases, then why would the effective tax rate, even if it's already at 25%, why would that not go lower? Who knows? To me, that seems to be something missing in that logic, in my opinion. As for infrastructure spending, something we've heard a lot about and something I've thought about for years, instead of pumping money into banks, why not pump money into the economy via infrastructure spending? There's plenty of infrastructure needs in the U.S., and ideally this would create this kind of, I hesitate to use the word trickle down because that has, I think, negative connotations from the 80s. But the idea that, if you start putting money into the economy to build things constructively, then that will put money in the hands of companies who will pay contractors, who will pay employees, who will spend money, and so on and so forth. That's the theory. But the thing is, how many quote unquote shovel ready projects are there out there that could be implemented really quickly? So the idea is that infrastructure is a big deal. And so it may take time to ramp up those projects, which means it'll take time to see the economic boost from that. Doug Ramsey from Leuthold Group, Leuthold. Again, no idea who these people are, but Randall Forsyth and Barron's magazine is quoting them, so therefore I assume they are credible. Doug Ramsey from the Leuthold Group thinks that the current market momentum and sentiment could carry things for 4 to 6 more months from now, which is great news. There was definitely a talk about the fact that the idea of the Santa Claus rally, it's not uncommon for markets to see significant rallies or boost through the month of December up until the end of the year as hedge funds and institutional fund managers are trying to boost their numbers and profits for 2016. And then that is not uncommon to potentially lead to a sell-off in 2017 as people want to balance that out and in different ways. And so it's not uncommon for there to be a drop-off in January and early in the year. So it'd be great news for the current momentum to carry things for 4 to 6 more months. But again, no one knows. I always talk about anytime someone predicts the future, know that there is a entirely fantastic chance they will be wrong because no one knows the future. But it is encouraging to know that this man, Doug Ramsey, who apparently is a legitimate source, seems to think that. To me, I don't know. It's hard to know what to expect. I hope the sentiment and momentum will continue. But it's hard for me to think that the current momentum won't see at least some kind of cooling off period sooner than later. And I was going to mention this at the end of the podcast, but I'll mention it now. I've actually had 2 friends in the last 3 days reach out to me via text asking me if I had any stock recommendations because they're really excited about the stock market right now. And these are 2 friends who we have talked about investing stuff before, so it's not completely coming out of the blue, but their enthusiasm and interest definitely piques a yellow or even red flag in my mind that we are at some extreme levels of bullishness right now. And again, that I don't sense that means crash level type stuff. Again, I don't know. I don't see it on that level, but it does seem that things got bullish really quick, and really bullish really quick, I should say. I don't think it's quite euphoric levels, but the fact that I'm seeing the bullishness I'm seeing, the markets have climbed as quickly and as far as they have, as well as the fact that I've got friends reaching out to me asking for stock advice who don't typically do that. That tells me this is a great chance to take a deep breath, to pause, to, as I told both of these friends, don't ever let emotions impact your investing. If you see a great opportunity and great value, then move forward. If you don't, then don't. There's nothing wrong with sitting on your cash if you have some. And there's nothing wrong with if you have some companies that have been big winners of late, nothing wrong with trimming those a little bit. Again, I have some different investors that I follow and respect deeply. I've been reading some of the reports of late, and it seems to be kind of saying some similar things that none of them are preaching doom and gloom necessarily. Well, one of them kind of is, but not necessarily preaching doom and gloom, but saying, hey, stay calm, relax, don't get caught up in the emotion of all this. Maybe trim some winners, but just stay calm and, be patient. And I think that's some really great wisdom and advice, in my opinion. As for interest rates, the Fed funds futures are pricing in. Basically they're saying the Fed funds futures are predicting. You can kind of look at what they're doing right now to predict what expectations are for future interest rate increases. Looking beyond, I'm recording this on December 13th, so the Fed is meeting, I believe currently or this week, to discuss whether or not they're going to increase rates 0.25% right now, which everyone is assuming they will. But apparently the Fed funds futures are pricing in 0.25% increases for 2017. One by June and another one by December. So basically at the end of the year, they're predicting that rates will be at 1 to 1.25%. So that's interesting that people are predicting that, but I feel like those predictions are very often wrong. But it doesn't hurt to be aware of expectations. There continues to be heavy liquidation in U.S. Treasuries by foreign monetary authorities. And in the last 12 months, total treasuries held at the New York Fed, which is kind of a proxy for tracking stuff like this, is down $186 billion, which is a lot, but it's important to remember it's down to $2.8 trillion. So, that's $186 billion compared to $2.8 trillion. So basically, they've dropped from roughly $3 trillion to $2.8 trillion. So still really big, but that's a definitely a measurable amount in decline in decline as far as treasuries being held there, which evidences the heavy liquidation in U.S. treasuries by foreign monetary policies. And that's consistent with the ongoing decline in China's foreign currency reserves, which have declined by $1 trillion from the 2014 peak of $3 trillion. So that is a very material and sizable decrease of 1/3. And from China's foreign currency reserves, because Beijing continues to attempt to slow or stop the decline in the value of the currency, which is the yuan. So definitely some interesting dynamics going on globally in terms of currencies and foreign monetary authorities liquidating U.S. treasuries, and just basically you just see lots of movement internationally in terms of foreign policy, in terms of currencies and treasuries. So you just see people all over the world shifting around, not really sure what to make of things or preparing for significant shifts coming up, which to me, again, I do not claim to be an expert on how all these dynamics work. I don't know that anyone is, because it gets really complicated because there's so many moving parts and different intentions. But to me, it does communicate that change is happening, and I am inclined to think that it's not necessarily exciting bullish change. I'll put it that way. But more to stay tuned for in the future, things to be aware of. And so that is the primary update for this week from Randall Forsyth's Up and Down Wall Street column entitled Making U.S. Stocks Great Again. I will probably have a different title for this podcast because I like to do that. I like to come up with my own titles. So I continue to remind you, please do not be emotional with your investing. It's easy to read news that may be bullish, it may be bearish, but it's important to focus on fundamentals. And Benjamin Graham talks about the idea of looking at your portfolios in quarters. And he talks about having half stocks, half bonds, or you can move it up to 75% stock, 25% bonds, or down to 25% stock and 75% bonds, depending upon how over or under or even valued the U.S. stock markets are. And right now, the U.S. markets are, on a historical price earnings ratio basis, the U.S. markets are overvalued, which means there's good reason to be cautious, which means there's good reason to move money, in my opinion, to cash. If you want to do the bond stock balance that Benjamin Graham suggests, you're welcome to do that. Obviously, I encourage you to do all of your own research and make your own decisions. I don't really do the bond side of that equation. I focus more on equities, and therefore, usually when I pull back from equities, I put money in cash instead. And so if you are so inclined to do so, I think there is very good reason to maintain a healthy cash position, whether you want that to be 25% or more. That is up to you. But that is my continued personal opinion. But again, please always do your own research. And thank you again so much for joining us here at Investor in the Family. I'd love to hear from all of you. Please feel free to email me at Brian, B-R-I-A-N, at investorinthefamily.com. Don't forget to do your Amazon Christmas shopping through my affiliate link. That's investorinthefamily.com/Amazon. You'll be redirected straight to the Amazon.com site you would have gone to anyway at no extra cost to you at all. But I get a small percentage on anything that you buy at that point. Again, no extra cost to you, and just a way for you to say, hey, thanks for doing this show. And again, thank you for listening. It's great to have you with us. And let's see, any other business to talk about right now? Don't forget to subscribe at iTunes, Stitcher, or the Google Play Store. And if you want to make sure and receive email updates, you can simply text the word Family Notes. That's one word, Family Notes, to the number 44222, or just visit investorinthefamily.com and sign up. And we'll take care of you from there. This is Brian, and thanks for joining the family.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.